वॉर की वजह से बाजार में भयंकर डर का माहौल है और ऊपर से निफ्टी के चार्ट पर बन गया है खतरनाक बेरिश किकर पैटर्न। साथ में है एक्सपायरी का प्रेशर। क्या आपका पोर्टफोलियो 23,700 के महा क्रैश के लिए तैयार है? इन डेप्थ एनालिसिस बाय हिमालयन स्टॉक्स गुरुकुल। डू फॉलो हिमालयन फ्रैक्शनल इन्वेस्टमेंट मॉडल फॉर फाइनेंशियल फ्रीडम। We need to strip away the panic and look at the math. With indices bleeding 5 to 6% over the last few sessions, the market's underlying support architecture has suffered a clean structural breakdown. What you are watching across your trading terminals is a sequence of cascading failures. The technical breakdown currently tearing through Indian equities is the final domestic step in a mechanical chain reaction that triggered thousands of miles away. To understand exactly what is happening to your portfolio, we have to trace the exact transmission of this shock. We will track the initial Middle Eastern oil spike, watch it force a currency collapse, follow that into institutional capital flight, and finally see it collide with domestic derivative friction. By mapping this exact mechanical transmission, we can look past the immediate red screens and accurately identify the hard mathematical realities that are dictating the Nifty's true support levels right now. The catalyst for this entire sequence starts here. Fresh U.S. military strikes in southern. When Secretary of State Marco Rubio outlined a timeline stating these operations would take a few days, markets immediately priced in prolonged systemic economic friction. The geographical vulnerability lies here, at the Strait of Hormuz, the primary choke point for global oil supply. This chart shows the market reaction. The threat of supply disruption here mechanically forces global crude spot prices upward. That global spike instantly hits Indian corporate realities. The resulting cost pressures triggered an immediate plunge in domestic energy equities, specifically impacting heavyweights like ONGC. A localized military strike in the Middle East operates as a direct tax on the entire global economy through the energy markets. When we bring our focus back within India's borders, that global oil tax collides with the nation's current account deficit. The mechanical link is direct. Because India imports the vast majority of its crude, a soaring global spot price immediately inflates the national import bill, forcefully widening that deficit. The consequence of that widening deficit is a severe currency shock. The rupee collapsed to the 95.78 mark against the US dollar. Market mechanics then act as an accelerant. Routine month-end corporate dollar demand piled onto the currency markets, making the rupee's downward slide even steeper. This dual pressure, the spiking deficit, combined with heavy dollar demand, overpowered the Reserve Bank of India's structural ability to intervene and stabilize the currency. Through this transmission mechanism, a foreign oil shock becomes a domestic inflation threat, actively eating into corporate profit margins across all sectors. Now we apply this currency collapse to the specific operators moving the largest volumes of capital, foreign institutional investors. Their primary operational metric is the dollar-adjusted return. Financial mechanics dictate that when the rupee depreciates against the dollar, these foreign entities lose real value on their Indian holdings, even if the underlying stock prices remain flat. This bar chart displays the resulting capital flight. The 2026 outflow trajectory has surpassed the 2025 record, registering a 2.42 lakh crore exit. On Tuesday alone, FIIs dumped another 2,407 crore rupees, proving the withdrawal is far from over. This concentrated extraction of global money inflicts disproportionate damage on the highest weight sectors, dragging down HDFC Bank and the Financial Services Index. This historic sell-off represents a mechanical no-confidence vote driven by the rupee's trajectory, moving independently of Indian corporate health. Down at the street level of the Indian market, this massive foreign capital flight has created an acute domestic liquidity vacuum. Right as this vacuum peaked, the government announced a 2% stake sale in Coal India via an offer for sale. By executing this OFS at a 10% discount, the offering siphons domestic capital away from the broader market at a time when liquidity is already desperately thin. Simultaneously, the domestic derivative markets are rapidly buckling under a compressed expiry timeline. This calendar illustrates the friction point. Because markets are shut Thursday for Bakri Eid, the BSE derivative expiry is forced into today's trading session. Traders are trapped. Forced unwiving in low liquidity triggers violent price swings. Combined with the Coal India sale and compressed rollovers, the risk for overnight option sellers expands as shock absorption collapses. Which brings us back to the alarming technical breakdown flashing across the Nifty 50. This chart of the Nifty 50 displays the bearish kicker candlestick formation. This specific shape serves as the visual aggregate of the oil shock, the rupee's decline, and the subsequent institutional flight. With this immense fundamental pressure weighing on the market, morning index rallies are consistently met by large blocks of institutional selling. This macro pressure has created a rigid technical resistance ceiling, firmly capping the market's upside at the 24,100 level. On the downside, the immediate structural support sitting between 23,700 and 23,750 is failing, exposing the path for the next leg down. Technical analysis is incomplete without macroeconomic context. Understanding this precise causal chain is the only way to accurately price risk in a geopolitically driven market. Do subscribe, like, share Himalayan Stocks Gurukul, and press the bell icon.